Let's take a look at how the performance of the markets impacted the Wespath fund returns. With that, I will turn it over to my colleague Karen Manczko for the update.
Thanks and hello everyone. The chart on the screen shows the net of all fee performance of the individual Wespath fund composites versus their respective market indices. The first row in the chart is our multiple asset fund, which is our flagship balanced portfolio. As a reminder, this fund has a 65% allocation to equities, 35% allocation to fixed income. The funds directly below the multiple asset fund are the four core Wespath funds that comprise it. The first column on the chart showcases the fourth quarter net of all fee performance results. And as you can see, and as Joe mentioned, the stock market performed positively after coming out of a negative third quarter, which created positive absolute performance for the multiple asset fund and the two equity funds that comprise it. Focusing on the two equity funds, which are the first two funds listed below the multiple asset fund in the chart, as I mentioned, these two funds comprise 65% of the multiple asset fund and were the primary driver of the quarter and year results. And those results were stock selection by our active managers. I'm going to highlight in a moment specific companies that impacted the performance. Also, the U.S. equity fund has an underweight allocation to mega cap stocks, which are the largest U.S. companies. This detracted from performance as we saw some really strong gains from these stocks this year. On a positive note, the two equity funds allocation to private equity contributed to the fund performance as we've seen strong results posted from this asset class for the quarter and year. Moving on to the two bond funds, starting with our fixed income fund composite, looking at the chart, you can see the fund modestly underperformed for the quarter and slightly outperformed for the year, net of all fees. The Inflation Protection Fund posted solid results for the quarter and the year, performing about 1% for the quarter and 6% for the year. And I'm going to talk more about this in a moment. Despite the quarter and year underperformance we experienced from the multiple asset fund and its corresponding funds, specifically the equity funds, you'll notice that if we separate out the 2-year fund performance time frame, which essentially is the COVID market time frame, which we normally don't highlight in our webinars, it showcases the extraordinary event of COVID and the impact it's had on the markets and our strategies. So looking at this time frame closer, you'll see that the multiple asset fund and the international equity fund outperformed their benchmarks, and the U.S. equity fund performed in line. The final comment I'll make on the slide before we move on is that despite the 2021 underperformance of the multiple asset fund, you can see that the fund has outperformed its benchmark across all trailing time periods net of all fees.
That 2-year perspective is really helpful, Karen, because of the volatility quarter on quarter. It's been fairly high, and there's been a significant change in the stocks that outperformed from 2020 to 2021. So putting in that context, the 2-year COVID time frame is really helpful. So back to multiple asset fund, how did it perform against peers?
That is a great segue into the next slide. And this chart showcases the multiple asset fund composite versus a universe of balanced funds. The universe is different from what we've shown in previous webinars. We want to measure how our balanced fund, the multiple asset fund, performed relative to other balanced portfolios and funds that are currently on the market. So we're using a universe that is compiled and maintained by Investment Metrics, which is a very well-known reporting provider in the investment industry. One of the things I'll point out is that the information is updated as of year-end and presented net of all fees. So you can see by looking at the chart that the multiple asset fund has performed below the median for the 1-year time horizon, but outperformed the median in the 3, 5, and 10-year time frames. For instance, in the 10-year time horizon, the multiple asset fund outperformed over 63% of other balanced funds in this comparison.
So Karen, moving on, tell us about the individual fund contributors and detractors for 2021.
Starting with our multiple asset fund, I talked briefly about this on the performance slide, but you can see the primary driver of the fund's underperformance for the year was the modest underperformance of the 4 funds that comprise the multiple asset fund. And I'm going to talk specifically about each of these funds in a moment.
Great. I mentioned during my comments that the equity markets were positive in the fourth quarter and for 2021, with the S&P 500 hitting new highs. How did the underweight of large cap in our U.S. equity fund, how was that impacted by this move in mega cap stocks?
You're right, Joe. The S&P 500 hit all new highs and ended the year in really strong results. What I find interesting is that 30% of that index return was driven by just a handful of mega cap names, which you highlighted in your equity market update. While we often say that we're underweight large cap stock, it really is an underweight to mega cap stocks. And this, unfortunately, was a big detractor to our relative performance of the fund. With this said, the long-term strategic allocation to overweight small and mid-cap stocks and underweight mega-cap stocks detracted, as we saw small and mid-cap stocks just really couldn't keep pace. Another detractor to the fund was our active manager stock selection. 3 of our 6 active managers underperformed, and specifically our 2 longest standing investment managers, Brown Capital Management and Zevenbergen. These 2 managers have historically been the best performing investment managers in our U.S. equity fund. And their investments in companies like Teladoc, Exact Science, and Proto Labs detracted from performance. These companies had really strong gains in 2020, but with that market rotation that we saw in 2021, these companies fell out of favor as investors moved into names that they believe are more pro-cyclical and they felt that would benefit from an economic recovery and higher interest rates. But on a positive note, the fund's allocation to private equity contributed to performance as private equity investments this year have posted some solid results. Turning our attention to our international equity fund, similar to the U.S. equity fund, is that the fund's primary underperformance was driven by stock selection of our active managers, specifically companies in China, Japan, and the UK. Joe, you noted earlier that our investments in China have been impacted by that continued government regulation and the impact that this had on technology companies. Also, the UK company Ocado, which is an online grocer, was impacted by inflation and the labor shortages that we've experienced. The final note I'll make on the slide is that the fund is underweight developed markets in lieu of having an allocation to international private equity and private real estate. This underweight was a detractor since we saw developed markets return over 11% last year, but this was offset by our performance results in our international private equity allocation.
So Karen, it seems like the main driver to the equity funds was the underperformance due to stock selection. So have we seen any major changes to the holdings from our active managers?
We've had some extraordinary years in the equity markets, and that's both benefited our active equity investment strategies and also has not benefited them. I think it's worth reiterating that our investment managers invest in companies that they believe will generate outsized results over multi-year periods. They don't invest just to capture short-term market gains. As a long-term investor, we understand and know that our investment managers or any investment manager will not always outperform. We've seen our investment managers make modest changes in their holdings while still continuing to adhere to their mandate that we've hired them to manage. We believe we have skilled investment managers that will continue to find investment opportunities that have not been fully appreciated by the market, and they will outperform over the long term.
Thanks, Karen. So moving on to the fixed income fund's performance, I noted during my market update that bonds have improved since their rocky start at the beginning of the year. Specifically, high yield bonds have done well, while treasuries and global bonds ended up in negative territory. How did this impact the fixed income fund, given the allocation to high yield and global bonds?
It's really been a challenging year for bonds, with the exception of high yield and U.S. inflation-linked bonds, which I'll talk more about that when I talk about our inflation protection fund. As you showcased earlier, high yield bonds were up over 5.3% in 2021, with the other bond asset classes in negative territory. When you showed the change in the yield curves, you saw that the yields increased from the end of 2020 to the end of 2021, which had a negative impact on the bond market year to date, all with the exception of high yield bonds. It's also worth noting that the US dollar increased relative to most emerging market currencies last year, which had a negative impact on some of those allocations in our funds. So with this said, the fixed income fund slightly outperformed its benchmark on a gross of fees basis. If you're focusing on the left part of the slide, you'll see the contributors, and the fund's overweight allocation to high yield bonds positively contributed to the fund performance, along with the issue selection by our Core Plus manager, PIMCO. I also want to note that our internally managed positive social purpose lending program also was a contributor as we saw credit spreads tightened, which benefited this investment. And also the fund's allocation to alternatives contributed to performance. Detractor to the fund performance includes the overweight allocation to global and emerging market bonds, specifically emerging markets, as we saw the dollar increase relative to those currencies last year.
All right, Karen, so moving on to our final fund, the Inflation Protection Fund. This fund has posted some solid gains this year and that you highlighted during your fund update. So tell us more about that.
Yeah, the Inflation Protection Fund really has showcased its purpose this year as being a fund that was created to protect investment portfolios against unanticipated inflation while providing a stream of income. And the fund returned over 6% in 2021. Relative to the fund's custom benchmark, the fund's underweight to UK inflation-linked bonds contributed to the performance. And despite US Treasury inflation-protected securities and floating rate senior secure loans having strong performance last year, the fund's overweight allocation to this asset class detracted from the fund performance since they couldn't keep pace with the fund's custom benchmark, which has a 10% allocation to commodities. And speaking of commodities, you noted earlier that they had a really strong year last year, primarily due to the increase in energy prices. And our overweight allocation to this asset class contributed to the fund performance. Finally, similar to our fixed income fund, the fund's allocation to emerging market inflation-linked bonds detracted as we saw the US dollar increase relative to these currencies, which also impacted this asset class. As I conclude my portion of the webinar, you noted that the markets rotated, and we saw that starting in the beginning of 2021. The areas of the market that did well in 2020 and before look much different than they did last year. And if I think about what was a contributor to the market movements and rotation, I think about how we came out of 2020 with the prospect of a vaccine that was really going to bring our lives some normalcy, back to those pre-COVID days that we all know. We learned about other COVID variants such as the Delta and Omicron, and how they can just as easy take the wind out of our sails and push back the idea that our lives will get back to those pre-COVID times. This also caused the markets to shift, which did not work in favor of our diversifying strategies. Given the remaining uncertainty in the market, we believe it's important to maintain a well-diversified portfolio and not to make drastic portfolio shifts as we move forward into 2022 and years following. We understand that there will be periods where our funds will be out of favor, but we believe that those periods will be few and far between. And as we've showcased through the year, our long-term strategic approach to investing has served our investors well in the long term, and will continue to maintain this strategic approach in the management of our funds.
Some great perspective, Karen. Thanks for that update.